This is CGTN, China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Uche Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, emerging market stocks fell for a sixth straight session today, with MSCI's index of emerging market shares slipping by 0.3% on the day. Now, the index was dragged down by tech heavyweights in Asia and, of course, a weaker market in South Africa. South Africa's JSE All Share saw resources take some shine off banking stocks today. And traders are saying a sell-off in the resources market more than offset a fairly solid session for banks and listed property. However, energy and chemicals firm Sasol did buck that trend as we saw its shares rise nearly 2% on the day, in line with Brent crude, which of course was trading at its best level in 2 years at about $72 a barrel. Now, also coming up on today's show, Ghana's inflation rate beats estimates and hits record lows in May. The U.S. passes a bill that will pump billions of dollars into tech research and development. And we show you how Ethiopian farmers are fighting climate change using gullies. And we start off today's show in Ghana. The country's inflation rate has dropped to a record low to 7.5% in May, and that's from 8.5% in April. Now, that is the lowest rate since at least the start of 2013. The slowdown brought inflation below the midpoint of the official target band of 6% to 10%, a lot earlier than the central bank had projected. The inflation rate in the West African economy was above 11% in May, June and July last year, at the peak of the pandemic and movement restrictions, and that of course created a high base for comparing year-on-year price moves. That and a relatively stable exchange rate added to the drop in the headline number last month. And moving on, the Organization of Economic Cooperation and Development says Tunisia's economy will expand at an annual rate of 3% in 2021 and 2022. In its latest economic outlook, the organization warns of coronavirus-related risks that could stifle a recovery of the country's vital tourism sector. But from Tunis, here's Adnan Shaushi with those details.
Tunisia is hoping to jumpstart its economic recovery after a sharp decline in 2020 caused by the outbreak of the COVID-19 pandemic. The country's economy, finance and investment development minister said the government is optimistic about post-pandemic recovery this year and in 2022, buoyed by rising inoculations in the world.
The repercussions of the COVID-19 pandemic will continue and affect more businesses and sectors. It's weakened the government's financial means and affected the population. However, GDP is projected to expand next year after a sharp decline amid the health crisis. The situation will certainly improve in the next few months.
The Paris-based Organization of Economic Cooperation and Development, OECD, said the labor-intensive services sectors are critical for Tunisia's recovery. Authorities in Tunis have already launched an online platform to support the most vulnerable groups and people who have lost their jobs during the pandemic. The number of recipients is about 1.2 million families.
Our aim is to boost the national economy by supporting individuals whose businesses and earnings were affected. This exceptional relief fund will finance household incomes and increase private consumption. This initiative is in line with the state's economic relief program during and after the pandemic.
The OECD report stressed that the tourism sector is one of the most affected sectors by the health crisis. The North African nation's tourism revenues plunged 55% during the first 4 months of 2021 compared to the same period in 2020. Experts say the national vaccination drive will revive this vital industry and create new jobs.
Tourism is completely devastated due to travel restrictions, lockdowns and layoffs. Now that the vaccination campaign is underway, hotels are reopening and hiring. We do not expect 100% of tourist resorts to be operational this year, but tourism revival will boost the economy and contribute to GDP growth in the next season.
Ratings agency Standard & Poor's expects a modest recovery of 3.8% in 2021 after last year's sharp GDP contraction. The fund has, however, warned that Tunisia's debt to GDP is forecast to grow to 91.2% this year from 87.6% in 2020. According to the National Institute of Statistics, Tunisia's weak economy has been hit hard by the pandemic, with GDP contracting 8.8% last year. Authorities aim to improve the investment climate and boost exports while bringing the health crisis under control. Adnan Shawishi, CGTN, Tunis.
Meanwhile, South Africa is seeking additional electricity from private contractors as the government moves to address long-standing power outages in the country. Now, South Africa has been experiencing rolling blackouts due to additional breakdowns at several power stations. Here's CGTN's Angelo Coppola with the details.
The government's latest drive to bolster the country's electricity grid is to increase the amount of renewable energy. But not everyone's convinced that this is the best approach, which leaves coal and nuclear.
Now, when I say coal, I'm not talking about Eskom-style coal, which is the filthiest coal generation probably in the world. I'm talking about clean coal, like you would find when you go to London and Boston and the first world countries, where you could stand right next to a power station and not even know it, other than for a slight vibration in the ground maybe from the turbines turning.
Eskom's current solar power suppliers' prices are higher than Eskom can legally charge its clients, and that leaves the utility with a problem.
Solar is very, very weak in winter, and even on average, it's only 4 hours of solar available per day. And most of our activities, our needs, are during the morning peak and during the afternoon peak. So, yes, solar might help out a little bit during the day, but all it does is actually push up Eskom's costs because they have to buy the solar, and they're not getting any revenue for the coal or other energy that they generate during the day.
Eskom and the Energy Department are also considering a more immediate option, approaching existing independent energy suppliers to increase their production.
But the fact of the matter is that the government and Eskom have treated suppliers so badly in the past. I mean, I've got a client who's a hydro supplier. He only does 1 or 2 or 3 megawatts. It's not a lot of power, but it certainly can help patch a hole. And these people have been so badly treated, both on and off decisions, and having them rush and prepare the installations and then not draw down on them, that I think that the sentiment towards government and Eskom is that we don't trust you, and you are too corrupted and you're unreliable as a partner.
As South Africa moves into that winter season, Eskom is hard-pressed to help consumers meet their electricity needs, and it's unlikely to do so anytime soon. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
And now to some of today's corporate headlines. Kenya's state-owned power utility, Kenya Power, has cancelled its tender, which sought a technical advisor to implement restructuring in the firm. Now, this comes amid plans to reduce debts, electricity theft, and employee costs. The loss-making utility firm first made an amendment to the initial tender by removing the clause on a phased reduction in workforce after an outcry from its employees. And South African Breweries has allocated $148 million towards capital investments in the country. The move comes amid hopes that the government will no longer impose alcohol bans. Now, the capital injection is earmarked for projects including upgrades to its operating facilities, the installation of new equipment at selected plants, product innovations, and other necessary operating systems. Meanwhile, Germany's Lufthansa Consulting is in talks with the Sudanese government over a potential role in restructuring its airline. A Lufthansa delegation is expected to travel to Khartoum this month to continue talks with Sudanese authorities. Founded in 1946, Sudan Airways stands to benefit from the country's reintegration with the global economy after the end of U.S. restrictions. And finally, Britain's Competition and Markets Authority has launched an investigation into whether British Airways and Ryanair have broken consumer laws by failing to offer refunds for flights that customers could not legally take. In many cases, the carriers instead offered vouchers or the option to rebook. The regulator adds that the airline's stance could have left customers out of pocket. And that's a look at some of today's corporate headlines. Well, let's now take a short break, still coming up on the show. We'll take a closer look at how the hotel industry is recovering from the pandemic in Africa, as well as Kenya's flower sector tapping into the Chinese market for more revenue.
Africa is the nexus of enterprise, and global business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues from taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Uche Okoronkwo. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home, and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference.
Africa is the nexus of enterprise, and Global Business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues from taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Welcome back. Well, let's shift our attention now to the impact of the coronavirus pandemic on Africa's hospitality sectors. They, of course, have seen a significant drop in revenues and a surge in job losses. Here in Kenya, tourist arrivals dropped by 72% in the first 10 months to October, from almost 1.8 million arrivals, which were recorded in the same period in 2019. Now, the sector was impacted by the various restrictions put in place to control the rapid spread spread of COVID-19. As a result, the African Development Bank expects tourism-dependent economies to experience sharp declines in growth in 2020. Experts, of course, predict that tourism-dependent countries such as Kenya have incurred losses estimated at $3 billion amid the onset of the pandemic. They also add that there is renewed hope for hotel and tourism sectors amid an expected recovery as a result of the reopening of economies across the continent. Well, let's dissect the pandemic's impact on Kenya's hospitality sector. We're now joined by Hasnain Noorani. He's the founder and CEO of East African hotel group Pride Inn. Great to have you with us on the show today, Mr. Noorani. Now, of course, let's start off with a short-term outlook for the industry here in Kenya, looking at the return to normalcy, the normal levels of operations and occupancy rates that existed before the pandemic. What is your short-term outlook? How significant have been the shift in numbers following the easing of restrictions and, of course, the deployment of vaccines across Kenya?
So definitely there has been a good increase in numbers. And if I may talk about the Kenya coast at the moment is hugely supported by the local tourism. And as the hospitality industry, as the hotel industry, we have managed to come up with some extremely good offers to attract the local tourism. And this has really supported the industry in the Kenya coast. However, once we look at Nairobi still has a lot to pick up. The occupancy pick has not been as much because Nairobi is very highly dependent on international tourism, international business, and international conferences. So whilst there's a bit of restriction on conferences, there's quite a bit of confusion in terms of what's happening. And yes, as much as vaccination is ongoing, it hasn't been fully and completely rolled out. So a lot of companies have got the restriction in conferences. Now, if you must understand that Nairobi's business relies a lot on the conference business in the conference market and in the international market. International market is very limited at the moment, again, because of those challenges. And the conference market, there's quite a bit of fear and there's restrictions from the government. So Mombasa is doing much better than what we have seen in Nairobi. The pickup in Mombasa and the Kenya coast has been much better than what we see in Nairobi.
Well, let's take a closer look at the financial position that most in the hospitality sector are in right now, given the pandemic. Of course, research in the global hospitality industry shows that almost every hospitality firm, including the big names, they're in some kind of debt. Revenues have declined 80%. Serious cash flow issues right now on ground. So give us some insight into how Pride Inn has weathered this storm and how it's affected your bottom line.
So definitely the year 2020 was one of those most unexpected years, something that we would have never imagined. However, when COVID came in, we realized that there was some immediate change had to be done, some immediate decisions had to be done, and those were hard decisions to be done. So we sat down and we looked at what are the areas of our fixed costs, what are the largest fixed costs that you said. And like you said, hospitality industry is hugely dependent on those elements of debt. So one of the first things we did is we sat down and looked at our high-end costs and our high fixed costs, and we looked at how we could reduce those. And one of the first things we did was negotiated with our banks. Luckily, we had, because even the banks understood that the hospitality industry has the one that has been hardest hit. So we sat down with the banks and courtesy of the government who tried to push into using the CBK, our bank was very flexible and we managed to get in some moratoriums in terms of repayments. So that was one of the first things we did. Secondly is we also negotiated with landlords or with the landlords of the maybe one or two properties that we had where we sat down to understand that this is a different term, where we had to sit, and in the event if the landlord also had his loans, we would also sit down with his banks to try and explain to them what the challenges are. And we managed to come to a sample agreement where it was a win-win for everyone. Thereafter, sitting down with our suppliers, and we looked at the suppliers, and we had a discussion with them, and we created some payment terms for those goods and services that had already been taken. Over and above that, obviously, we all know that staff costs and the payroll costs are also huge because hospitality industry is hugely people-driven. So whilst as the CEO, I was very much against doing some layoffs. One of the things we do realize is that our teams have been there for us when they were good times. There was no way I was going to release them when the times were bad. So instead, we sat down with the entire team and we looked at all the possibilities, and we agreed on some level of pay cuts so that we could sustain the entire team without having to do any layoffs. So it is these few things that we did in the initial stages that enabled us to sustain ourselves, that enabled us to sustain our cash flows. Remember, the focus was on the cash flow. It was not on the profitability or the losses. We were sure that even though we would have the losses, the business would recover one day. We wanted to make sure that we were able to sustain with our cash flows, which is what we negotiated. Over and above that, we quickly sat down to look at what are the other areas of revenues that we could target on. And we came up with some innovative tactics in terms of how to still go on with our revenue. We realized that the cheese had moved. And what we did is we came up with something known as RevNet, which is a platform that combines the actual meetings with the virtual meetings together. And this is something that we introduced to the clients, that they didn't really have to stop their business and that they could still continue having their business virtually. So we would try to combine a conference room in Nairobi with a conference room in Mombasa. People in Nairobi could go to the conference rooms in Nairobi, and people in Mombasa could go to the conference rooms in Mombasa. And that's how we sustained some little bits of revenue over and above targeting the local tourism. So these are some of the steps that we took to ensure that we could sustain our cash flows and minimize our losses.
That's quite interesting, because there's been a lot of discussion around what they're calling the next normal for the industry, and how clear the long-term implications of this pandemic will be on the hotel industry going forward. What are your thoughts on what the next normal will be, how hotels have to adapt their strategies in the long term, as well as their operations and finances?
Definitely, COVID is there to stay with us, and all hotels have to definitely be prepared to ensure that they are very much COVID compliant. I am very confident that once a large portion of the vaccination is rolled out, there will definitely be a travel boom. People would want to travel. Over the past 2 years, people have realized the importance of traveling. So whilst virtual meetings have taken charge at the moment, however, a lot of business is not really cannot be done virtually. All right, you could have some trainings that could be done virtually; those are fine. But a lot of business has to be done based on emotion. So we are confident that conferences, the MICE industry is going to pick up. We are confident that the leisure industry, if at all, is going to pick up even better than what it has ever been before. However, with hotels, but to be able to target the right kind of clientele, everyone, right from the government to the airlines, to the hotel operators, to the tour operators, everyone has to work together to ensure COVID protocols are being obtained. Over and above that, ensuring that everyone working within the hospitality industry, right from the CEO all the way to everyone within the team, is vaccinated. And this is what would give confidence to people. And as long as that happens, we believe so that we should be able to bounce back to normal. The only challenge that may happen is that initially in conference rooms, we would occupy to maximum capacities. Maybe going future, the same conference rooms would now be holding lesser capacities than what they would actually hold, making sure that we are leaving the 2 meter or the 1.5 meter gaps between two participants. So there might not be as close interactions, but the MICE business and the leisure business will definitely come back.
Well, how about the discussion around technology? Because if there's one thing COVID-19 exposed or brought forth is our reliance on technology. And there's been some debate around how COVID-19 also exposed a technology gap in the hotel industry. What are your thoughts on how hotels have to adapt to this? And how big a role do you think technology will play in the sector post-pandemic?
Indeed, technology... there was this huge gap, and this has been exposed by COVID, the technology gap. And going forward, it will indeed play a huge role. A lot of companies and hospitality industries have to continuously be innovative. The reliance on ensuring that your hotel is able to provide high-end Wi-Fi would be very important for people to continue doing their business. And this, if at all, is only going to ensure that hotels have to be continuously innovative. So like I said, one of the products that we quickly launched was RevNet, which was something that we would have never thought of. And to be honest, it has made within our own company it's made our life easier in terms of communicating within the various teams that we have across Nairobi and Mombasa. So yes, technology is going to definitely make an impact. Hotels have to be very quick to turn around. Hotels have to be very quick to adapt to and to keep on learning on what are the new technologies that are keeping on coming up. Because without these technologies, you may assume that you will start losing business.
Thank you so much, Mr. Noorani, for that very insightful discussion. That, of course, is Hassanin Noorani. He is the founder and CEO of East African hotel group Pride Inn. Well, let's stay in Kenya now. The country's flower sector is turning to China's lucrative market in an effort to boost its earnings and diversify from traditional markets. But, of course, aftershocks from the COVID-19 pandemic are still being felt in the sector despite a rebound. Here's CGTN's Robert Nagila with more.
It's mid-morning at the Redlands Roses flower farm in Ruiru, about 45 kilometers from Nairobi. The first of 3 daily harvests is almost complete. There are over 200 variants of roses grown here in what can be described as a labor-intensive process from the point of planting to boxing. Kenya is the third largest exporter of cut flowers, with Europe accounting for about 70% of its roses. In 2019, flower exports generated about $1 billion in sales. To boost sales, more farms like Redlands have entered the lucrative Chinese market.
We started 5 years ago because it's a very big country, so a big volume of consumers and a big volume of high acquisitive power.
After harvest, the flowers are taken for processing to identify quality roses for export. The flower farm exports spray roses to China. These have more than one flower per stem.
Because of the COVID, the business stopped quite a long time in China. We were at about 100 boxes to 200 boxes a week, and currently we are at 100 boxes, but it's increasing.
Like other sectors, flower exports plunged at the onset of the pandemic. But as global markets have reopened, the sector has rebounded. But the after effects are still being felt.
We have a very limited number of cargo planes moving from Kenya to China weekly. So this is really our major problem, is to find freight capacity. It's limiting really our growth in China.
Currently, only China Southern Airlines operates cargo freight between the two countries. Back at Redlands, the final process, boxing the fresh flowers, is underway. From here, they'll be transported to the airport and onto a plane for the Chinese market. Robert Nagila, CGTN, Nairobi, Kenya.
And heading to Tunisia now, the country's industrial production recorded an 8.2% jump in the first quarter of 2021 as it shrugged off the decline in output recorded in the fourth quarter of 2020. Now, according to the country's National Institute of Statistics, manufacturing and extractive industries grew the most during the period, and they were boosted by increased investments. Here's CGTN's Adnan Shaushi reporting.
Tunisia's Ministry of Industry, Energy and Mines explained that the upward trend is the result of an increased domestic investment by 15% and foreign direct investment by 30%.
These positive results of industrial production show the business and investment climate in Tunisia is still viewed as favorable by local and foreign investors. The state now aims to boost industrial production in all sectors while attracting more capital. More investment in industrial sector means more production in Tunisia.
The Director General of the Agency for the Promotion of Industry and Innovation added that the COVID-19 pandemic took its toll on the industry last year. However, the negative repercussions have been limited since January 2021. In fact, the number of declared investments has risen by 24%.
2020 was marked by a deep crisis. The borders were closed, exports suspended, and investors reluctant to fund projects. Despite all these factors, the first 4 months of 2021 show the true potential of the Tunisian industry. The launch of new projects will reduce unemployment by up to 2.3%. These economic forecasts depend on the post-pandemic crisis management.
Experts in the North African state have urged the government to reform the industrial sector. Almost half of Tunisia's manufacturing environment is oriented towards overseas markets, with 2,500 fully exporting companies out of a total of 5,500 firms.
Tunisia's industrial sector is closely tied up to the agriculture and service sectors and other industries. Industrial production is up, but the upward trend needs some conditions to be maintained. It needs urgent reforms, or Tunisia will remain dependent on Europe. Our main aim is to become the factory of Europe, but we are still a small workshop of Europe.
According to the monthly report of the National Observatory of Energy and Mining, exports of energy products recorded a 75% increase in value during the first quarter of 2021. This as the energy trade balance deficit dropped by 41%. The COVID-19 pandemic and the general lockdown simultaneously suppressed domestic supply and international demand in 2020. Authorities say Tunisia's industrial production and manufacturing industries would benefit from a post-pandemic economic recovery. Adnan Shawishi, CGTN, Tunis.
You're watching Global Business Africa. We're going to take a short break now, still coming up on the show. The U.S. passes a bill that will pump billions of dollars into technology research and development. And Abu Dhabi launches a new crude oil futures contract to better connect its oil fields with global markets.
It's just taken me completely out of my depth, but at the same time it's exciting. It's new, it's different, it's a challenge.
It's really exciting.
No one again began holding guns. Machine guns from police forces towards the protesters.
Were you worried about your life at that particular time?
Not at all.
The activity, thank you very much for your time. What is your assessment of the state of the continent today?
Africa has the potential to power itself.
Excuse me.
Business in Africa is at the crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant.
Only on CGTN.
How will your world change today? What happens here? What happens there? Or what do you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
I try to not let it affect me, but there are days when it does. I'm a human being, and to see patients in a hospital bed and their family members are not there, there's no one there to hold their hand, that human touch, you know?
I just hope everyone can remember that the situation is not permanent and that everything will get better eventually.
And here's a quick recap of today's top headlines. Mali's leaders intend to restore civilian rule in the Sahel state. This was the reassurance given to a delegation from ECOWAS, which was sent to Mali to mediate a transition toward elections in the country. However, the African Union has suspended Mali's membership, and France halted its joint military operations with the country. Meanwhile, Kenya's President Uhuru Kenyatta is calling for those operating in the illegal manufacture of guns to join the government firearms factory. Now, the factory was opened in April to cut the cost of acquiring weapons for security forces. Kenyatta made the remarks as he led security agencies in destroying over 5,000 illicit firearms recovered in 2020. And France is again welcoming foreign tourists to the country as it enters its penultimate phase of easing COVID-19 curbs. This is after the country lifted a 7-month ban on indoor dining, albeit with restrictions. Now, the nationwide curfew has, however, rolled back to 11 p.m. And that's a recap of today's top headlines. And now to some international news. The U.S. Senate has passed a sweeping technology and industrial policy bill, which lawmakers say is aimed at competing with China. The Innovation and Competition Act will pump hundreds of billions of dollars into research and development in a number of technological areas, including semiconductors, artificial intelligence, and quantum science. Now, the bill now heads to the House of Representatives, which earlier passed a different version. The two will be reconciled into a single bill before it is sent to the White House for the president's approval. In response, a Chinese Foreign Ministry spokesperson said the U.S. should not treat China as an imaginary enemy.
We urge the United States to treat China's development and China-U.S. relations rationally, stop promoting such bills, and stop interfering in China's internal affairs so as not to damage overall bilateral relations and cooperation in important areas between the two sides.
Well, let's delve further into that bill with John Terrett. He now joins us in New York. Great to have you with us, as always, John. Now, of course, as we mentioned, China's foreign ministry has firmly objected to this bill. It expressed its strong indignation and resolute opposition, in quotes, to the legislation. What are the most striking parts of this bill that, of course, reflect this administration's stance on China?
Well, hey there, Uche. Thanks for having me on your show. This is a very wide-ranging bill. We call it a sweeping bill, which means that it covers so many different topics regarding China. And I like to think of it, and I pass this on to you now, I like to think of it really as a bill that has swept up all the sort of anti-China discussion and committee work that's been going on Capitol Hill in Washington, D.C. for the best part of the last 5 years or so. It all comes together in this one bill. And it's also really dressed up as a sort of investment bill. So it is an anti-China bill, but it's being sold really to Americans as an investment bill. And it's got money for semiconductor research and development and production, $52 billion. Now that's because they don't want to be so reliant on China in the future for semiconductors and to try and get over the shortage that we now have in the world. There's money, as I think you were saying in the intro there, for universities, for other kinds of research and development, and then crucially for building relations. And this is where the theme of the bill really comes in. They want to reach out to countries like Japan and Australia, and certainly many, many, many countries in Africa where China is presently very active and would like to be more active in the future. So that relationship building is a direct target on President Xi's Belt and Road initiative. And the other thing you should think of, Uche, with this bill, it really is aimed at boosting significantly American influence in the world, particularly in places where China is operating at the moment and would like to operate in the future. And the other part of it is to try and diminish China's influence, particularly military and economic, in many parts of the world. But there is a big but about this. It's very important to understand. There's no money behind this bill. Well, there is money, of course. They're putting $52 billion into microchip research, and in total it comes out to just over $250 billion. But in the great scheme of things, Uche, that's really nothing at all, particularly when you spread it out over 10 years or whatever it is that it's going to be. So lots of very strong ideas, but not much money to actually make them happen, Uche.
Well, as you say, John, this really targets that tech race between China and the U.S. So on that note, does this bill reveal any change in the U.S. previous hard stance when it comes to U.S.-China relations, especially the hard stance we saw under Trump's administration?
Well, we did see a hard stance, didn't we? We absolutely did. And we all know what that was like during the course of the 4 years of the Trump administration. And I think, surprisingly, really not much has changed under the Biden administration. A lot of people thought that he would be far softer on China than he actually has been. And I think you can put it like this. You can say that President Biden is as America first as President Trump was. It's just that he goes about it in a different way, slightly more subtly, I think is one way of putting it. I mean, you have to remember, only last week we were reporting that he boosted to 59. He didn't reduce, he boosted to 59 the number of Chinese companies and corporations that Americans are no longer allowed to invest in, even if they wanted to. And those companies, those Chinese companies that were delisted at the New York Stock Exchange under the Trump administration, under an executive order that he signed, that they have not been rowed back. They're still not trading here in New York City. Now, having said that, we do have breaking news in America for you, because within the last couple of hours, the White House has let it be known that President Biden is actually rowing back on an executive order that was signed by President Trump and intended to stop fresh downloads of WeChat and also TikTok. Now, what the Biden administration is doing is they're going to ask the Commerce Department here to look into those two companies and see if there is any kind of security risk by having them operate freely in the United States. So that actually is a little bit of rowback on policy in favor of China, as it were, but we'll have to see what the outcome is of the inquiry. Uche?
Well, so far, as you said, the bill has seen mostly bipartisan support, but what has been the widespread response to it from critics of this administration, U.S. allies, we've talked about China, and of course the private sector?
Yeah, well, China, of course, pushed back. You played the clip at the top of the interview there. China, I mean, I think China's been relatively reserved in its criticism, and I think there's a couple of reasons for that. First of all, China doesn't comment on domestic spending. It's not really Beijing's way to say, you know, you have to spend this money this way, but not that way. And secondly, I think that there is an element of this bill that plays into Beijing's hands in the sense that they can say, look, you know, don't tell us how to run our country and we won't tell you how to run your country. I'm not really very aware of corporate responses to this bill so far, or even responses from other countries. But one thing I can tell you is that it has almost universal support, in Washington, D.C. I mean, the politicians here can't agree on anything. All this spending that President Biden is talking about, not a penny of it has been approved yet, and it's showing no signs of being approved, but they can approve on a bill that aims to take down China a little bit. And the reason for that is, and I'm not sure how this has developed, but it's happened over the last 5 years, China is frequently attacked on television here now. China is seen as the greatest threat to America's way of life, and that crops up time and time again. And some think tanks here blame China itself for its own dilemma, but you know, I mean, what can you say? I mean, it's going to go into law. It passed the Senate in the last 24 hours. It will now move down the passage in Washington to the House. They will look at the bill, they'll add things, they'll take things away, and then they will bring the two bills together. And it's likely, we're told, to be on the president's desk for signing, and he's up for signing it sometime in July. Uche?
Well, certainly interesting times ahead. Many thanks for your insights, as always, John. That, of course, is John Terrett joining us there in New York. Now, China's telecom giant Huawei has launched its largest global cybersecurity and privacy protection transparency center in South China. Our reporter Omar Khan is in Guangzhou and brings us the key takeaways from that launch.
Just a few days ago, a big release from them with the Harmony OS coming out last week, and today their new sort of global transparency center based there in Dongguan in Songshan Lake at that main Huawei campus. You had mentioned it right there, a sort of global gathering of those tuning in and giving keynote speeches at this event, of course, which was held online. A lot of those partners and collaborators not able to travel to China right now because of the global pandemic. So that's open today. Now, I do want to point out this is not the first sort of privacy and transparency center that Huawei has opened. It's actually the 7th. They have several in Europe, in the Middle East, and of course in North America. So this is a continuing process that they've been engaging in. Now, what is this all about? I think that was a main question from a lot of us tuning in. Huawei said it's about showcasing its commitment to building a secure cyberspace. Now, rotating chairman Ken Hu spoke extensively about the dangers and the growing fears, especially coming online with so many cyber attacks happening. He did recognize that, yes, because of the pandemic that we've been experiencing, so much has been shifted online, a lot of people working from home, and the sort of norm has become that everything is going online and becoming digital, and he recognized that is a major issue. Hence, there's this center being rolled out there in Dongguan. He also acknowledged that even telecommunications firms like Huawei, they lack collaboration in cybersecurity. So perhaps a hint, Huawei would be looking to partner with other organizations around the world to tackle those issues, to give more transparency, not only to consumers, but of course governments and other agencies. He did outline 3 main functions of this specific center in Dongguan. They are to demonstrate solutions, facilitate communication and innovation, and to provide a platform for security testing and verification.
Meanwhile, in Abu Dhabi, a new oil futures contract has recently been launched. Its stated aim is to change how Middle East crude is purchased. Well, CGTN's Jacob Greaves has been taking a look at what the Murban crude oil futures might mean for the region.
It's a new exchange hoping to better connect Abu Dhabi's oil fields with global markets. International exchanges operator ICE is behind the new Murban futures contract, but it's being fueled by Abu Dhabi's and state oil giant ADNOC's main export, Murban grade crude, with one principal market in mind.
The Murban crude oil, 80% or 80 or 85% of it is exported to Asia. Prior to the launch of IFED and its flagship contract, the Murban future contract, buyers or sellers did not have truly a direct tool for hedging their forward price risk. Now they do. For the month of May, we've seen an average daily volume slightly short of 8,000 contracts, which is almost a 15% increase since the average daily volume for the month of April. So far, since March 29th, we traded a total of 340,000 contracts.
Each of those contracts amounts to around 1,000 barrels of crude. ADNOC has the capacity to produce 2 million barrels per day of the company's flagship crude grade. They've touted this new platform as a means to increase price transparency for global buyers and traders. Murban futures have the potential to be a big development in the evolution of how crude is traded in the Middle East. But that will greatly depend on how readily the market adopts these contracts, particularly given the regional competition. There's the largest producer in the Gulf, Saudi Arabia, which currently uses a method linked to Omani crude futures traded on the Dubai Mercantile Exchange. And it will mean convincing traders to change purchasing habits.
Attracting liquidity is always absolutely vital for a new futures contract. And of course, the more liquidity is there is, the more liquidity is attracted. And the two main benchmarks today, WTI in the United States and Brent in the UK, as international benchmarks, are enormously liquid. I think that no other crude contract has managed to attract that level of liquidity. Now, there has always been a gap in the market for Middle East crudes going to Asia, and that's now the key trade in the world. It's and there's been a number of attempts to provide the benchmark for that, and Murban is one of those.
It comes at a time when major regional oil producers look at how to capitalise on growing Asian demand. And those at ICE Futures are trying to pitch Murban as a potential benchmark for US exporters.
The Murban is very similar to the WTI, hence it can be a price mechanism for all these exporters, meaning exporting crude oil from the US to Asia.
That might be some way down the pipeline as they try to make it the go-to regional benchmark. For now, it's about convincing more buyers and traders to get on board. Jacob Greaves, CGTN in Dubai.
And on that note, here's a quick look at the commodity markets today. Gold trading in a tight range as investors eyed more data on U.S. inflation and, of course, cues on monetary policy from the European Central Bank. While, of course, weaker bond yields did help to offer some support to the metal today. Meanwhile, oil prices rising for a second session on signs of strong fuel demand in Western economies. While, of course, the prospect of Iranian supplies returning faded as the U.S. Secretary of State said sanctions against Tehran were unlikely to be lifted. Well, we are heading to a short break now. Do stay with us. We'll be right back.
Africa is a continent of diversity, with varied climates and enchanting geography, and a people so distinct, but with a shared enduring spirit. We are at the heart of the continent to bring you the untold stories.
Let's have a look.
We celebrate Africa as it shapes its own destiny.
I've been Tunis, Cairo,
Juba,
Johannesburg, Ethiopia, Tanzania.
Africa Live. Find your voice.
Images may appear to be identical, but looks can be deceiving. The difference is not always obvious. It has to be discovered. There are always different sides to a story. We put the focus on the details. To see more, to understand better. CGTN. See the difference.
The greatest journeys, the greatest sights, the greatest adventures.
Here in Qanater, this weir allows the locals to walk on water.
We're far more than just TV news. We're your passport to the wonders of Africa.
To bring you stories of struggle, survival and hope.
So let's explore. CGTN. See the difference.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about.
CGTN, see the difference.
Now, in an effort to mitigate the effects of the COVID-19 pandemic and climate change, Ethiopia has enlisted workers to reinforce a network of irrigation gullies that will stop heavy flooding from washing away their fertile soil. Here's CGTN's Terry Wangari with more on grassroots tonight.
In the highlands of Ethiopia, a community in the northern Amhara region is repairing and reinforcing irrigation gullies. The area used to be covered by farms, but heavy flooding has washed away the soil, leaving farmers with less food to sell and feed their families with. The gullies are part of an irrigation system that directs the rainwater and traps soil.
This work is about maintaining the gullies. First, we collect and prepare the stones. Then we dig into the ground, and then we put in the gabions.
These farmers work for Rural Poor Stimulus Facility, which was set up by the International Fund for Agricultural Development. It supports rural communities whose livelihoods were severely impacted by the COVID-19 pandemic.
The money we earn here has changed our lives. If you want to know, firstly, we are now able to buy sheep for the Easter festival. Secondly, we can now eat eggs as we are rearing chicken. And thirdly, we have the capacity to buy clothes for our kids, and we are living without a worry.
Before, farmers had to travel to other areas to find work. Now, local jobs mean they can stay close to home, reducing their exposure to the coronavirus.
The benefit of our work for this community is that we are helping to save the environment from soil erosion, and the youth from the community are getting employment and earning income to cover expenses.
The project's organizers hope that the combination of a simple solution, community involvement, and food security will help people here survive these global challenges. Terry Wangari, CGTN.
And before we close, here's a quick look at Africa's currencies. South Africa's rand rising 0.3% today, holding its ground after better than expected economic growth data the previous day did help to boost hopes of an improvement in the country's finances. Now, in early trading, the rand, which is of course the world's current top performing major emerging market currency this year, it was flat at around 13.56 rand per dollar and just off a 28-month high hit on Friday. Meanwhile, Nigeria's naira continues to hover at around 502 naira to the dollar at the parallel market. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me, Uche Okoronkwo, and the rest of the team, thanks for watching.